Hi, everybody. Welcome to the What It Means podcast, where I dig into the hows and whys of the housing market. I'm Jonathan Miller, and for those of you that don't know me, I'm the co-founder and CEO of Miller Samuel Real Estate Appraisers based in New York, and I've been appraising for about 40 years. I am also the author of the Douglas Elliman Market Report series, and I have been doing that for 31 years. And I teach market analysis at Columbia University for the grad school, one of the grad school programs. And I'm the author of Housing Notes, which you can find at housingnotes.com. I would love you to subscribe. I've been writing these commentaries for about more than a decade. Wow. So there's a lot of time spent in the real estate conversation. What I'd like to do first is a little good news before I get to tariffs. New York City's population has been rising for the last couple of years. So the narrative of people leaving New York has passed. What has changed is the net migration. So the net population is rising when you take away, outbound versus inbound, the math results in a positive. The net population is becoming more international. And I know over the last couple of months, I've been asked by a lot of reporters, they're hearing from real estate agents, they're dealing with more international consumers, buyers of New York City property. And I've been saying, well, I'm not seeing it, but it seems sort of like more of a remote possibility, because the dollar, even though it's been weakening because of the trade war, there's not enough of a discount. In other words, a European looking at the United States 10 years ago, we're enjoying a 40 to 50% discount just based on currency on a U.S. housing price. But it's starting to look like, with more international in the population, that real estate agents probably are seeing, it's not just anecdotal, that they are seeing more international buyers, which I think is good for the New York City metro housing market. I just wanted to, about 2 weeks ago, we published our Hamptons and Long Island and Los Angeles and Orange County market reports. And I just wanted to touch on them real briefly, and then I'm going to go into a little bit about LA. When we look at the Hamptons and Long Island, those housing markets are quite strong. The Hamptons is probably continues to be one of the strongest performing. I'll explain what strong means. Strongest performing housing markets in the New York City metro area. And what it means is that hey, that's the name of my podcast. Uh, what it means to me is that uh, we have been seeing inventory come in, but that's enabled a lot more sales. Sales are up 85% year over year from near all-time lows. And we're seeing prices rise. This is a high-end housing market. It's basically a luxury second home market that's joined at the hip with Wall Street. It is enjoying, I think, this boom in activity because Wall Street um, reported record bonuses in 2024 and record profits. So it's been a good year for markets that are affiliated with the securities industry in New York. Long Island, also very robust, all-time highs in prices, and the second lowest in inventory in on record, at least in the 25 or so years I've been tracking the Long Island housing market. And if you think about it, I think Long Island sort of mirrors what we're seeing nationally in terms of mid-sized cities and suburban markets, which at least north of the Sun Belt states in the South, like your Texases and your Floridas, inventory is still the most important metric to follow because inventory remains very low. And then we also released studies on the West Coast, Orange County and LA, and those housing markets are seeing actually more inventory come into the market, modest sales growth, and prices are rising. So when we think of the national housing picture, it's generally, in most markets, not all markets, inventory is rising, but in many markets, it's still inadequate. Sales are, um, it depends on the market, but generally speaking, sales in the first quarter have improved, but that is sort of pre-tariff, and I'm going to explore that in a few minutes anyway. And I think the universal pattern is that prices continue to rise because inventory has been challenged. In fact, prices are rising despite the fact that mortgage rates are sort of stuck, in the high sixes, below 7% on a 30-year mortgage. One of the things that I wrote about in my in my housing notes rather, this past week, was sort of this idea of, we're seeing, the housing affordability, it continues to be challenged because of rising prices and high mortgage rates. But at the same time, we're seeing these record price transactions, super luxury. So there was a sale in Naples, Florida last week for $225 million. And that turns out to be the highest sale price ever in Florida and the second highest price in the US. The highest price, of course, was the Ken Griffin $239 million condo in Manhattan on Central Park South. I just want to make a point, and this will bring me into the tariff discussion, is that Ken Griffin, the purchaser of that and many other high-end properties around the U.S. and internationally, has said that the introduction of the tariff policies by the current administration, and he was a big supporter of the president during the election, but that it has devalued the U.S. by about 20%. In other words, that there are sort of long-term damages being, I'm not going to go into all this, but the idea is that this is an overlying sort of negative on the U.S. economy. Just to illustrate what this whole tariff policy is based on, and the reason why I'm bringing it up is because, us being in the housing sector, one of our big focuses is bringing down the cost of financing, that mortgage rates, bringing down mortgage rates. And the way to think about a tariff, if I go into the local pharmacy and buy a Mother's Day card for $4 for my mom, I now have a $4 trade deficit with the pharmacy. And that is essentially what is being done to all the countries that the U.S. trades with, is that it is an accounting measure. It is not reflect that we're being taken advantage of in any way. So this whole thing is quite bizarre, if not dumb. And the expansion of it right now, you probably read that the tariffs are put on a 90-day pause. Well, that's not really true. The tariffs are going into there's a lot of tariffs going in. Just the latest round was what was paused. So right now, the container ships coming into the port of Los Angeles, which is one of the biggest ports in the U.S. In terms of inbound trade, the ships are 40% emptier. And what that means is that in 2 or 3 weeks, maybe longer, because many people ordered in advance in anticipation of the tariffs, anticipating the outcome of the election. Um, but the reality is that within a month or so, we're going to have a lot of empty shelves like we had with COVID, for lesser priced items. Well, across the board, but specifically when you go into, a Walgreens or a CVS pharmacy or a grocery store, there's going to be a lot on the shelf. So a lot missing from the shelf. So I bring this up only in that, everybody who's listened to me knows I'm very critical of the lack of strategy or policy that goes into the tariffs, um, introduction, that they're based on something fundamentally misunderstood by the administration. But we're in an environment where mortgage rates are stuck. They're in the high sixes. I find it sort of fascinating that we have Fannie Mae or Freddie Mac, who releases the mortgage numbers. If the mortgage rate drops 0.02%, they write, rates are falling. But rates have been sort of stuck at an elevated level. On the sort of positive side is that the consumer is getting used to that. And I still think there's an expectation in 2 or 3 years that rates will be a little bit lower. The thing I'm worried about is something that I graduated from college in the early 80s, and we had a thing called stagflation. And that is something that you're going to read or hear a lot more about in the coming weeks and months. The stagflation means an economic period where we have, higher rates and lower economic growth. It's not a good thing. Um, and I think the one, just because I don't want to, spend the whole podcast on tariffs, but the odds of recession by most of the big financial institutions are at about 60%, which means that means job loss is going to escalate as people are laid off because of the shortage of supplies. It also means that new home construction is going to become continuing to become more expensive. And in fact, even before the shelves begin to lighten up, the sort of protests by retaliatory protests by markets like Canada are already causing increased layoffs in the U.S. Because they're not buying our products. They're protesting because of this is part of the trade war and retaliation. In fact, an economist that I follow, I want to say religiously, his name is Torsten Slok. He's from Apollo. I know him. Um, he uh, he is predict that the odds of a recession could be as high as 90%, or others are saying we're already in a recession. So what a recession means is job loss, and some people think it means lower rates, but it doesn't with the tariffs. It really doesn't. So we're sort of stuck. And I and and maybe, if we go for the next couple of months without seesawing every day with new announcements, that the consumer won't be spooked. Right now, at least anecdotally, we'll be releasing the hard data in New York and Florida, and our new signed contract reports on Thursday. But anecdotally, at least in New York with my appraisal firm, we're definitely seeing activity. That the market is not pausing or freezing, at least in New York, and that's just one market. I'm not speaking for the entire U.S. The other when I was talking about the West Coast, I wanted to mention, just to give a little bit of color, with Pacific Palisades and the wildfire devastation. They lost about 5,500 single families in that market in the Los Angeles area. And I recently read that there's 200 lots on the market, and that is supposed to peak, meaning inventory is supposed to peak by the end of the year. But there are currently 37 under contract or in escrow. And what's really interesting about that is that the contracts that have been signed. One example I read that one house had 60 offers and not one below the asking price. One of the things I've written about a lot in my career is that when you're talking specifically with single family homes, that the improvements, the house itself depreciates over time unless you provide maintenance to it, or upgrade or add an addition or whatever. It's land that appreciates, and the improvements depreciate. And so in theory, these properties are not, there is no, in sort of air quotes, fire sale. That these properties are still substantially valued. It's just that the buyer is looking at, probably a number of years to actually have their home reconstructed. So it's many homeowners are debating whether to wait, put in the time, or move. I think a lot of that is still up in the air. I know that the local municipalities are working to reduce the the lag in approvals for building permits and construction permits and the like. I don't know offhand whether that's had a noticeable effect yet, but I do know that there's a concerted effort. So I'm somewhat encouraged by that. Um, the other the other point I wanted to bring up, and this is more of a it's more of a gradual sort of it's sort of a slow motion phenomenon, but the way to think about where we are right now in the housing market is we're in this period of transition. Um, and usually when you're in a period of transition, you're anticipating the next step and you're preparing to go to that next step. What we have right now is that we don't know where we're headed. You don't know, I don't know, no one knows. Because there is no real fundamental understanding of we just learned that international movies might be subject to 100% tariff, which will devastate California and other markets like Georgia, where a lot of production work happens. But we don't know. Maybe that will happen. Maybe that won't happen. There really is no plan. And so and I've said this in the past, um, the 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 way that I would approach this is to not overanalyze what's going on. I fear I'm doing a little bit too much of that myself, because we just don't know. I think what we do know is that there is a lack of clarity on what the future looks like. Um, as I like to say, our uncertainty has uncertainty. But I'm still, long term, I'm still pretty optimistic. It's just going to be 2025 is going to be a confusing year. I will say, um, it, if you want, you're welcome to, I should have said this earlier, welcome to throw questions at me in the Q&A box on your Zoom screen. And we can talk through, but the idea here is that we don't know much, but we don't know what we don't know. I find in New York, New York has sort of been late to the party, and now maybe is sort of leading the party in terms of activity, which has been happening, elevated activity since last summer. Um, Other markets like Florida are seeing um, less activity and more inventory, um, but more strength at the higher end of the market. One thing I want to get to real briefly is on a national basis. Um, if you look at the regions of the US, like the Northeast, the South, the Midwest, and the West, to break it out like that, sales activity of housing prices nationwide in those regions, starting at around $500,000, are up year over year quite a bit. In fact, in the Northeast, where I'm sitting, sales over $1 million in the Northeast region of the US are up 26% year over year. I mean, that's a big number. And we're seeing that we're starting to see that in some of the regions that we cover in the Northeast. In the South, prices, I'm thinking of Florida, where Douglas Elliman has a big footprint, and we cover 14 or 15 markets through our market report series, that we're seeing sales over $1 million up about 15%. So this housing market, as you skew higher in price, those consumers are better equipped for the conditions that might lay in front of us. In other words, mortgage rates not really changing all that much. Uh, that as you move higher in wealth or in income or in property value, that you have a higher probability of getting a better mortgage rate, as much as a couple percentage points below the 7% prevailing number. And those consumers also look at the financial markets more than they look at rates. The financial markets are still year to date are still below where that we started the year at. But we're not seeing, I think the anticipation, and I've mentioned this before, of some real estate agents, and I think it's probably right, is that there will continue to be, a consumer looking at more tangible assets like real estate versus intangible assets like financial markets, just because of their recent volatility. I have somebody just asked me a question about my opinion on new construction homes for sale in Los Angeles. Um, uh, I think we're a little bit early, but the cost of the materials will be higher for new construction because of the tariffs, and labor because of the immigration policies. I'm not getting into right or wrong, but just the fact that they're there is also, will drive the cost of construction a little bit higher. I don't think there's going to be much discounting in land, especially with some of the anecdotal evidence that I've come across already with bidding wars. But prices could soften a bit if a lot of property come into the market over the next year or two. But even then, I don't see it as any kind of dramatic price correction, at least at this point. So I think new construction is the costs are, the new homes are going to be more expensive. However, that's where the demand is. As I was just saying earlier, in the national numbers, we're seeing an increase, a much more noticeable increase in sales activity as you skew higher in price, and new construction tends to be within that tranche of the market, that price segment of the market anyway. So I'm not so sure, at least in the luxury space, meaning the top 10% of the market, that new construction costs are going to be a significant drag on demand. I think the drag is going to be the time it'll take with everybody sort of building at the same time. The drag will be on the time it'll take to get a construction job completed. So hopefully that answers the question. I think the other point I want to bring up is that I I'm trying to figure out how to articulate this, is that um, the unknown is, always a drag on the consumer. It takes longer to make decisions. So even if the tariffs don't fully go away, which I don't think they will, I think they'll be, over the course of the year, I think there'll probably be some pullback as we see sort of the economic impact unfolding. But if there isn't this sort of day-to-day chaos in policy coming out of Washington, I think the consumer will remain in the market. The worst thing that can happen is, daily chaos, which we've had, a tremendous amount with no real strategy or plan. So I'm hopeful that this will get old after a while, and we'll actually have a spring market. We're in the spring right now, early May and June, sort of ending with 4th of July is sort of peak spring. I do anticipate, us continuing to have an uptick in sales activity. The demand is there, but I don't see it as being a boom that it had the potential to be when we were thinking about it back in January about what the spring market looked like. If you remember, the spring in 2024 was sort of a non-event. It was very mild spring market because there was an anticipation of 3 rate cuts by the Fed, and they didn't happen until later. This year, the probability of recession was 10% in January. Now it's 60, as much as 90% to who you're talking about. So there's just a lot more uncertainty. So I do think that that's going to restrain nationally activity in the spring. But I do want to point out that new signed contracts nationally are actually on a month-over-month basis are up after adjusting for seasonality, which is somewhat unexpected. Contract sales, and this is for March, being reported at the end of April. But at the end of March, which was before the tariffs were implemented, we did see signs that the market was rising or growing. I suspect that will be muted or restrained this next reporting month because of the implementation of the tariffs and the uncertainty that they bring. But I do think that there's still a lot of momentum in the market. And I think, unless there's any other questions, I've probably gone on a bit of too much about tariffs. But I do want to thank you for being with me and listening to this, and hopefully you'll stay in touch. I'd love you to go to housingnotes.com. It's free. Sign up. I post 3 commentaries a week, and they're usually what your colleagues and buyers and sellers are thinking and talking about, so you might find it helpful. And also, I'm happy by email to take any questions that you might have. We're trying to do these podcasts about once a week, and we all have busy lives. So hopefully, I'm especially grateful for you spending time with me. But the most important thing I want you to take away from this is to remember that pie is always better than cake. Thanks.